Hello and welcome to today's Premium Account Investor Signals Market Update for May 2016. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hine, Managing Director of Investor Signals, have 18 years of experience in the financial services industry and a current licensed securities and derivatives advisor. The format for today's presentation, we look at the macro update driving equities. We roll through the ASX Top 50 with a particular focus on the FES 16 earnings and importantly starting to flag what FES 17 earnings look like. We look at the technical trends in the market and conclude with the portfolio allocation and short-term market outlook. The Investor Signals Premium Account Service is a model portfolio of ASX 50 stocks. We utilise call options to enhance portfolio returns focused around effective ownership on ex-dividend dates, generating above average cash flow while still looking for capital growth, all under a strict investment mandate, therefore suitable for self-managed super funds, and importantly the assets remain in your name. If you'd like to know more about the Investor Signals service or simply like to have a chat with me, please contact me using the details on screen. Okay, moving straight into a graph of the US market. And I've got a few here to look at from a macro perspective, but I'm not going to spend a lot of time chatting about the background. We're going to look at the technical structure. In the US, we're seeing the March quarter earnings slightly beat very low expectations. So we've seen significant revenue misses, we've seen significant profit downgrades, in some cases in the order of 30-40% within the financial services sector. The industrial stocks have done okay, some of the big technology names have missed earnings, and if we have a look on screen here, what we're seeing is the Dow rally back, and I suppose what's a little bit unknown at the moment is, do we consolidate at these levels? And at 17 times earnings on forward earnings, not a lot in the way of earnings growth. Companies still buying back a lot of their shares, which is helping to make earnings growth look better than what it actually is. Cost control still being a big driver, and then obviously not a lot of global growth globally at a macro level. Now, the pullback in the US dollar at the margin helps some of the multinationals in the US, and we may see the benefit of that in the next 3 to 6 months. But all things being equal, probably the US dollar's seen the most part of that correction, so I don't think that's kind of an ongoing factor that really sort of drives earnings. And I think in a benign global growth environment like that we have, I think there needs to be a certain amount of caution as far as the expectations as to what future earnings growth, especially where valuations sit at the moment. So let me just move through a couple of these graphs. So on the NASDAQ, so this is the technology sector. So again, over the last week or two, we've seen a number of the big tech companies report in the US, and obviously Facebook's been an exception. Its results were an absolute standout, but generally the tech sector in the US is under pressure, coming back from very high multiples, and we've got a fairly negative structure in place there, so we're keeping an eye on that, seeing how that plays out. Looking at Japan, that's certainly broken the uptrend support there. We're seeing the ongoing stimulus measures there, negative interest rates not actually leading to a huge pickup in earnings. Obviously, there's a lot of cheap cash flowing into corporations in Japan, and that's being applied to global acquisitions. The central bank in Japan's become a very substantial shareholder, nearly in all sort of top-tier companies in Japan. So we're seeing sort of that quantitative easing, or that money coming into asset purchasing and Japanese stocks. So even in the face of very aggressive buying from the central bank in Japan, we're not actually seeing that reflected in an overly bullish price structure there. So that's a reason for caution. Let's move on. Let's say in Hong Kong. So we can see here the index, the Hang Seng Index, still a negative structure there. Let's have a quick look at the Shanghai Composite in China. So we can see here that it's rolling over. So lower lows, lower highs, pressure to the downside. I think maybe this becomes a fairly, if there was to be an area of weakness in the market that unstabilizes or destabilizes things, it could actually be the Shanghai Composite. But if that does happen, I think it'll ultimately present a very, very good buying opportunity. So we keep an eye out on that over the months ahead, and I'll continue to comment on that, especially from an exchange traded fund perspective and adding exposure. And it may be 3 or 6 months away before we look at that, but certainly worth keeping an eye on it. The CAC 40, which is the French or France market here, so we've seen lower lows, lower highs there as well. And then finally, maybe just have a quick look at gold. So as I've spoken about, gold's breaking to the upside. We're seeing higher highs and higher lows as effectively the world moves into a negative interest rate environment. Gold's looking more attractive as an asset class. And then the US Treasury, so this is a real test to say what's the market thinking in terms of the US interest rates going to increase or not. Now, we've seen again speculation from the Fed Reserve that whilst they're not looking at doing anything short term, probably in the next 2 to 3 months, there's still an expectation among some of the Fed members that they want to raise rates at least twice before the end of the year. I don't know that the US economy is strong enough to withstand that, but this is a benchmark here that we look at. If the market's believing that the US is going to raise rates, we'd expect to start to see these 10-year bond yields start to make higher highs and higher lows. At the moment, that's still trending lower. All right, let's move to the domestic market, the ASX top 50 stocks. So lower lows, lower highs. Our market trades on a forward PE of about 16 times earnings. Now, that's not really a fair indication. You've got a big chunk of the market that's horribly overvalued, and then you've got an area of the market, say, in particular the resource sector, which is substantially undervalued, which is creating sort of what appears to be an acceptable average PE, but actually when you dig deeper, and that's part of the focus of today's recording, some of these PEs are getting up to levels that, are unsustainable, and in a good case, I think they move sideways. In a negative scenario, there's room for a correction to the downside. But on that note, let's move straight into the top 50 stocks, and I'll share with you my views and strategy around what we're doing here. So AGL, I actually like this name. I think in a relative sense, the PE is starting to look attractive versus its forward earnings outlook. So we were buyers of this over the last couple of weeks at around this $18 level. We've gone out and sold calls up around the $19 level, collecting the upcoming August dividend, which will be something in the order of probably about 35 cents or so. And then we've got the extra premium from that call option. So we're delivering well and truly over 10% cash flow on an annualized basis from AGL. Don't see too much risk to the downside. Pretty comfortable with that as a safe area to park money in this market. Asiano continues on the watch list, but as I've mentioned, we're interested in it post the breakup, and we'll take a look at it through Cube. Amcor, this name's obviously been a darling of the market. We've seen it in the past doing small bolt-on acquisitions in the emerging markets. Over the last couple of weeks, they've made a very substantial acquisition in South America, which will be earnings accretive, and the market's really got excited about that sort of added growth profile. But the stock's trading on a really expensive PE, up in excess of 20 times earnings, probably on current numbers in actual fact, not allowing for what the EPS upgrade looks like off the back of this acquisition, but trading at least up around 24 times current earnings. On forward numbers, it comes back to probably something closer to around 19, 20 times earnings, but on less than a 3% dividend yield, it's looking very expensive up here at 16 odd dollars, and we're seeing a bit of weakness today. But again, it may be, given that it really is a great company that's continuing to deliver compounding annual earnings growth. The acquisitions that they've been making have been disciplined. Even the recent acquisition, I think, was only at sort of maybe 8.5 times earnings. So they're buying value in the market, and they're getting the synergy cost benefits from these acquisitions, and it's a relatively defensive sector that they're operating in. So we're very attracted to Amcor. If in cases where we certainly own it at lower levels, and we've sold the covered calls over it, but I think really probably fair value to me is probably more back down around $15. And in the context that we want to keep it in portfolios, we're really thinking about how can we make money out of Amcor on the assumption that it moves sideways over the next 6 to 12 months at around that $15 price range. AMP not doing anything here at the moment. Look, it's on the radar. It'll be interesting to see whether it can break through this sort of $6 level and ultimately create a higher low. But at the moment, from a technical perspective, the structure looks a little bit negative. We're preferring other financial services names such as the ASX, but in the case of AMP, it trades about 15 times earnings. Underlying earnings growth may be somewhere in the order of 5%, but certainly on the radar, but not doing anything there at the moment. ANZ, we've seen that probably their banking result come out. It was at the lower end of expectations. Bad loans had increased as we expected. We'd been aggressive with this name, selling the $25 call options last month. We got over $1 for those, so it's actually worked out quite well in that we've collected the dollar premium last month, plus we've managed to keep exposure to the stock and collect the 80-cent dividend today. So we now look to sort of sell a covered call out a little bit further over ANZ, and I think across all the banks we're lucky to see 5% capital growth from the current levels. APA, I think this is a name that belongs in portfolio. It's a defensive yield name. ASX, this has been our preferred financial services exposure. Up at these levels, the stock gets expensive, trades on about a 4.5% dividend yield, underlying earnings growth of about 5%. I think the only argument to owning it at these levels is whether you're confident there's going to be a takeover offer. Otherwise, it's at the top end of the valuation range. The recent trading update for March showed some weakness in equity volume. We saw Chi-X winning a little bit more market share. So I don't think there's the underlying earnings to really drive ASX too much higher, and that's pretty much been my standard comment around this for most part of the last 6 months. But at around $44, full value, good dividend yield, chance of a takeover offer at maybe 30% premium whilst the Liberals are in power there. So Horizon, from a technical structure, this is looking a little bit negative. It's had a good bounce back. We've sold the calls at around the 420 level, looking for the stock mainly to trade sideways. BHP, look, pressure's still to the downside. This is one that I highlighted last month where the structure's still negative, and whilst that's in play, it's pretty hard to get sort of too bullish. We'd actually sold calls over BHP at around the 21.50 level into May. We got good premium for those, so again, sort of driving cash flow out of some of these names. Bramble, so this is a name that we've been overweight in portfolios, a little like Amcor, great exposure, has a lot of offshore earnings, growing earnings at about 8%, but getting very expensive, trading 24 times earnings on a 2.75% dividend yield. So it is likely to see 8% earnings growth sort of year on year over the next 2 or 3 years. So if you go out to, say, 2018 earnings, the company starts to look okay from a valuation standpoint, but you're paying up for the next couple of years worth of earnings growth, and therefore to have an assumption that the stock trades $15 or something in the short term just seems like a real stretch to me. So whilst we're interested in keeping exposure to these names, I still think the right way is to run a fairly tight covered call and effectively deliver the same return from the dividend and the call option on the basis that the stock moves sideways. And if in fact that is what plays out, then you're far better off than sort of just holding the stock hoping for ongoing capital gain. CBA, so fair value as with all the banks at these levels, so we don't see too much, and the technical structure is still negative, which sort of stops us from getting too bullish on them at present. Coca-Cola, 5% earnings growth. The stock trades on about a 4.5-5% dividend yield. We've been selling the covered calls up at around the $9 to $9.50 level, so turning sort of that cash flow into sort of in excess of 10% per annum. Computershare forward earnings probably should miss by about 7 to 8% for 2016. So when you look back at the trend in the earnings of Computershare over the last 18 months, it hasn't been all that rosy, and that's reflected in this negative price structure where we see lower lows and lower highs. And for that reason, to the extent that we own Computershare, we're being very aggressive with the covered calls. I think it probably has further pressure to the downside. CSL, we like this name. We've been buyers of it on the dip here at around $100. We've gone all the way out to December and sold the covered calls at $110. We got very good premium for that, so getting about 10% cash flow and allowing for about 10% capital gain from now through to the end of the year. So CSL's performing well for us. Caltex. So this name, we own it at lower levels. We'd sold the covered calls. We've collected the recent dividend and we've collected the call option income, which wound off at the end of April. Now what we look to do is reset that call into the second half of the year, collect the August dividend and try to bring in some further cash flow off the back of that option premium. I don't see Caltex trading too much above sort of $36.50 to $37. I think that's full value given the current earnings update that they've provided. A Goodman Group. So these property stocks are getting expensive, and just to put this in context, trading about 18 times earnings on just over a 3% dividend yield. Our preferred property stock remains GPT, but again expensive, 4.5% dividend yield, 18 times earnings. Maybe the company delivers 5 to 6% underlying earnings growth. I think fair value for GPT is around $5. To the extent that we own it, we're selling 5.25 covered calls. We'll collect the upcoming dividend in June, and those calls are set out into September, and we've collected very good premium for those. So again, we're getting paid over 10% cash flow for holding GPT. IAG, now you may remember 6 months ago, this was one of the first investments that Berkshire Hathaway made in Australia. So they have roughly 20% of the reinsurance business of IAG. And I think that probably says something about IAG as a long-term investment opportunity. The company's de-risked their business a little by winding back their operations in China, and I think that'll bode well for sort of the volatility of the stock over the coming years. The stock had been in a lower low, lower high structure. It now looks to be breaking higher, so I think it potentially comes back onto the radar as a buy on the dip at around $5.50. IPL, the structure here is negative. We've seen Orica come out today with a horrible earnings miss. That's put a bit of pressure on IPL. I still think that we probably get through their earnings result in the next week or two. It'll probably be, I think, an average to negative earnings result, and it will probably create a buying opportunity. So in next month's recording, we'll actually focus on IPL. I think probably 12 to 24 months out, the stock will be higher than where it is at today. James Hardie, so exposure into the building sector, in particular the US, where numbers still remain fairly robust. So this stock looks okay to me, probably trading sideways up at around $19 to $20. Lendlease, so we have this name where we've sold covered calls over to around the $14.50. I really think it just moves sideways. We're collecting the call option income and the dividend, driving that up to around 10% cash flow. The stock trades only on a 10% PE, and that's really reflective of concerns around settlement of unit sales in Melbourne and Sydney, and general sort of negative sentiment around the unit market in particular, and to some extent just property. I guess where we've seen the banks discontinue finance to non-residents, and those type of issues are weighing on sentiment around do companies such as Lendlease have a building problem around the prospect of failed settlements on pre-sold units is probably the key area that I think is weighing on sentiment with Lendlease. I think it might be a little bit overdone. I think the stock's probably okay value it here, but at first we just expect it to trade sideways and then look to see if we get confirmation of a better outlook sort of statement as they get into their June earnings release. Mirvac Group, not doing there at present. MPL, I think this is the right stock within, it's obviously insurance space, but within the medical sector. But again, it's getting expensive, compressing down to a 3.25% dividend yield. The interesting thing here with Medibank is it's much about a cost out story. So it's but it's been a government business that's gone private, and the company's managing to run well ahead of prospectus forecasts with their cost cutting. We've seen upgrade to the premium, I think roughly around 5-6% increase in their average premium that they're able to charge, which is all helping to underpin earnings, but it is expensive. So again, we own it at lower levels. We've made very good money out of it. Where is fair value? I think it's probably something closer to $3 than it is where it's trading at the moment. So to the extent that we own it, we've still been fairly aggressive selling the $3.25 covered calls over it. Macquarie came out with their FES 16 earnings, which delivered roughly close to $2 billion in earnings. FES 17 should look the same. The argument at the moment is with the stock trading on a dividend yield of around 5.5 times earnings, 5.5%, and only 11 times earnings, the stock's good value. Obviously, the big risk there is the macro trends in global equities, and my concern here is the stock's still in a negative structure, lower lows, lower highs. So until that changes, we're not getting bullish there on Macquarie. NAB, we've seen them deliver a good earnings result, about 5% underlying growth, reaffirm their dividend of 99 cents, and we're seeing some pickup in growth in their domestic business lending book, which is sort of the traditional strength of NAB. So the fact that they're sort of returning back to their grassroots, the market's tending to like that story, and we should see the price to earnings, or the PE valuation gap between NAB and, say, Westpac and CBA start to close a little. And for that reason, NAB fair value is up here around $28.50, but don't see it doing too much more than that. Newcrest doing very well in the backdrop of a lower Aussie dollar and strengthening gold prices. Origin, so the $5.50 calls that we'd sold wound off last month, and we've now moved out, sold those at $6.50, so driving extra cash flow from Origin. Don't see it doing too much above that $6.50 strike. So here we are with Orica. Its earnings results came out today, and we've seen them cut the dividends and the earnings miss expectations as well. So fair value for Orica over the next sort of 6 months to me sits probably closer around $12.50. Oil Search, so to the extent that we own it, we're trying to sell the covered calls over that. We don't see upside much above $7.25, $7.50 short term. Not doing there in Qantas. QBE, interesting to see the earnings update here on QBE. Generally, insurance businesses are struggling with low global bond yields, and we'll have a look at sort of whether QBE's insurance margins start to improve. A little bit further discipline, or as far as the commentary out of the company saying that they're more disciplined around cost control, but we're still in a negative structure, so it's not one of the stocks that we're overweight in portfolios. Ramsay Health Care, so I've chatted about this one, trading on almost now 30 times earnings again on a less than a 2% dividend yield. So after consolidating, it looks like it's wanting to break higher. We'll have a look at it in the months ahead if we get a pullback. Rio, interesting that Rio's under pressure at the moment, and really on the back of, I suppose, iron ore prices just pulling back a little bit from their highs. But a lot of data out this week on China, so it'll be interesting to see sort of come the end of the week where market sentiment is around these resource names. Scentre Group, so this has been one of our preferred sort of exposures recently as well. So we've been buying it, selling the covered calls. Again, trading up at around 20 times earnings on a 4.5% dividend yield. These property trusts are expensive, and we think complementing them with a covered call option and not looking for too much in the way of capital growth is the right way to play exposure to the REITs at the moment. Seek, this is a name that we've added into portfolios. We've been buyers of it over the last few weeks at lower prices. We've sold calls up at around the $17 level. We see this as a quick opportunity to lock in some capital gain, and then we'll revisit the stock on the next pullback. Stockland, so around about 7-8% underlying earnings growth. This one's actually been a little bit stronger than I expected. I thought it had consolidated around sort of this $4.25 or $4 level. It's actually pushed a lot higher. So it comes back onto the radar, but we're not doing anything there at the moment. Sonic Healthcare delivered an okay result, 16 times earnings and a 5.5% dividend yield. I think the stock looks okay. We own it at lower levels. We'd sold the covered calls up at around $19.50 to $20. So if we end up delivering the stock this month up at around that price point, we've locked in roughly 10% capital gain across the last few months, plus exposure to the March dividend and the call option income. So Sonic's been a good contributor to portfolio performance. Santos not doing there at present. Suncorp, just a flag that the Suncorp sort of closing this gap here. It'll be interesting to see how price behaves up at around $13. To the extent that we own it, we're selling covered calls up at around $13.50 there. Sydney Airport, so this is one that we've been adding into portfolios. We own it at lower levels back here. We've sold the covered calls at the $6.75 level out into September. So if we end up having to deliver the stock ahead of the June dividend, that'll be fine. We'll generate a very good return on capital over a short period of time. I think the underlying story for Sydney Airports continues to look attractive, but on sort of a 4% dividend yield, the stock's getting sort of fairly compressed and is looking a little bit expensive. Transurban, same story there as Sydney Airports, albeit trading on less than a 4% dividend yield now. Forward dividends over the next 12 months, probably somewhere around 45 to 47 cents. So at less than a 4% dividend yield is looking expensive. Telstra's had some increased buying interest off the back of the expectation of $1.5 billion capital return to shareholders. I don't think it's been announced exactly how that's going to be done, whether it'll be through a share buyback or a special dividend or how that's going to be done. But the stock at sort of these levels on a 5.65% dividend yield, I think from an income perspective, that it looks okay on the basis that it probably trades sideways. But still, from a yield perspective, if you can get over the concerns around what the telecommunications space, or in particular, what does the earnings of Telstra look like post-NBN? The company's already commented that they expect to see roughly a $3 billion hole in earnings, sort of post-NBN being implemented and Telstra effectively just becoming a reseller of bandwidth, just as the other telecommunication companies, albeit that in the mobile space, Telstra really is a clear leader, and that's the strength of the business there. So, look, I think even though the structure's a little bit negative here in Telstra, I think there's probably a building case that this deserves to be maybe at least an equal to overweight position in portfolios. Vicinity centres, this is on the radar, not unless we see a pullback. So if we get a period of weakness in the market over the months ahead and the market sort of sells off these REIT stocks, then I think this is a name that we want to be looking at on a pullback. Westpac, as with all the banks, maybe 5% capital upside, but don't see too much there to get excited about. So they're kind of an equal weight with a covered call. Wesfarmers, roughly trading on about a 5% dividend yield. Our strategy here is that we own this stock at lower levels and we've sold the covered calls mostly up at around $45, so allowing a good 10% capital gain plus the combination of the dividend and the call option there. Westfield, we like this name. We continue to sort of chase this higher. I think it's a name that you can continually build on in portfolios. It does trade on a 3.5% dividend yield, so again needs to be complemented with a covered call option. And Woodside Petroleum is, with all the energy stocks, a little bit under pressure. And there we are, back to the index. Thank you for listening in. If you'd like to know more about the Investor Signals service, please contact me using the details on screen.